So yesterday wasn't that bad. A little bit of hurry up and wait. We've got another day of that to hurry up and wait, but at least we did get some of the QRA data yesterday. And I was a little shocked, I guess is the word, that there were still people that reacted oddly at 3 o'clock and said, "What was that? What happened? Why did the market move?" And it's not on them. I'm not calling them out. It's on the rest of us that point out things every day and warn you guys about things to be aware of and things to be cautious about. That we must not have done a good enough job because there was still people yesterday who were not prepared and had no idea what happened at 3 o'clock. Just got to do a better job. Yesterday at 3 o'clock, we got part of the QRA data. We got the proposal. We're going to see the rest of it on Wednesday at 8:30, I believe. And then in the later part of the day on Wednesday, we're going to get FOMC. Busy week. Taking a look at how the market responded to the data we got yesterday, we can see the UK is still up 0.5%, Japan up 0.25%, and Hong Kong and the Dow basically flat. S&P and the NASDAQ a little under flat, and the Russell down almost 0.5%. So we're still not getting that capital rotation we're looking for. We're still not getting the boost from small businesses. And there was an article on Bloomberg yesterday talking about how many small businesses are struggling and going under. And I can't remember the metric that they were using, or I would bring it up, but it does tie into, are the feds holding in a restrictive territory or not? Sure, maybe the big banks aren't filling it, the big companies, but certainly the smaller companies are. So we're going to get a little bit of data today. Today's not the big day. Wednesday is, and then Friday is as well. We got non-farm payrolls on Friday. But we are going to have some earnings today as well. So while today isn't the big one when it comes to data, some of the earnings that are going to report after the close today, they're pretty big deal. Japan did intervene. It wasn't very big, and they didn't have coordinated assistance like they did last time. The last time they had a lot more help. This time seems like almost a reflex maneuver, and it didn't really stick. So it's very likely that they're going to have to do it again. Volume is sitting at 67K. So another day of lower volume than the day before. It's still within tolerable standards, and it makes sense with everything on deck that we would see a lower volume. There is no reason to anticipate, a bunch of large institutions wanting to come in and position themselves before a radical change in market structure. I mean, think about it from your own point of view. Would you want to load the boat on a bunch of swing trades right before such a radical event like FOMC? I wouldn't. So neither would they, right? So seeing the lower volume makes sense. It'll be interesting to see what the commitment of traders report says next Friday. Remember, it's delayed by a Friday. They get all the data on Friday. They process it by Tuesday. They put the report out by the next Friday. So this week's data we'll see next Friday. We don't have an MDP. We've been crisscrossing back and forth through the pivot point all night. We don't have an inside day breakout, and we don't have our inside week breakout anymore either. We're back inside last week's range. We are still holding above that call wall, which oddly enough did not get rolled yesterday. And we did get the founder's note for this morning, which is great because we don't normally get one so early in the morning, but I haven't had a chance to go through it yet. So I'm hoping that they expanded a little bit on the call wall, give us some clarity and some guidance on what's going on there. I really would have expected it to have been rolled yesterday, but they didn't. We're still holding above it. So it's worth keeping our eye on it just to see if it's going to get moved at this point. It is like semiconductor day, if you think about it from that earnings point of view. AMD, SMCI, they're both going to be reporting. I know they're not the only semiconductors out there, but they are two of the big ones. So we're still holding it above the 3-week moving average. We're above the 10-week and the 10-day moving average. So from that point of view, we are holding the line at this level, and we're riding above that weekly pivot point. But today is expected to be another one of those hurry up and wait days, just like yesterday. You can see how we just held the line yesterday. Sell into strength, buy into weakness, and wait for data. When we got that data, we did make a move to the downside, and it was brought right back up again. For one, this is like a liquidity gap, which we'll talk more about on Friday, because we're going to get another opportunity to have that 8:30 liquidity gap move when we get non-farm payrolls. So we had the big move, we closed the gap, and actually created another one with that drive back up. But we're still just holding the line, waiting for FOMC and QRA data. So tomorrow morning, 8:30, we're going to get the QRA and then FOMC at 2 o'clock. And hopefully I won't see someone say tomorrow at 2 o'clock, oh, wow, what was that? Why did the market just make a big move? Yesterday did kind of do us a favor when we got this move to the downside as far as we did, all the way down to that 10 MA. Because now we've got our boundaries for the week. Not what I'm looking for. Guess we'll just make one. By the way, Thinkorswim was down yesterday. Schwab and TD Ameritrade's Thinkorswim showed up on down detector. So if you noticed your Thinkorswim not working well yesterday, it wasn't just yours, it was everybody's. It didn't last long. They got it back up and running relatively quick, but It was on down detector for a little bit. When I strip everything away, it makes it really easy to see these ADR lines. And we're basically holding in the middle of them. I know we're closer to one than the other because we're never going to be just exactly perfectly in the middle. But this is the distance between the two ADR ranges, 1.37%, just like yesterday. So we've got yesterday's high and low, and thanks to that move to the downside, it's not too constricted. That opened us up just a little bit. So we've got yesterday's range, and then we've got our own ADR range to deal with. That's two levels right there, but we can add to this. We've also got our own Globex high and our own Globex low. So now we've got those levels as well. Should we make a move to the upside, we've got to get through our own Globex high and then break yesterday's high. Then we can start working on the upper ADR levels like 5183. To the downside, we have to break our own Globex low and then yesterday's low and then the ADR low at 5113. We can add to all of these, at least with this Globex low here, but that doesn't really help since it lines up with the Globex low that we've already got, basically. And we could try to do the same thing with the Globex high from yesterday as well, except that it lines up really close with our own Globex high from today, so there's no point. They're just too close together. It would just muddy the water and make things harder to see. So when we line it up this way, we can see the bias is more to the downside. We're contained within the structure of the lower side of the structure. But this is our expectation that we're going to ride inside of this zone into the end of the day today. And then after hours, maybe one of the semis that are going to report gives us a move after hours. Then the world will deal with it in the overnight. We'll come back tomorrow and deal with what we have before QRA and FOMC. Now, it is possible that we can break the range and actually begin to expand. We've seen it before. That's not the base case argument. FOMC is volatility suppressing, a phrase that I used to think was completely wrong. But it is volatility suppressing. And it's not, nobody's saying that when FOMC happens Wednesday at 2 o'clock, that there's no volatility and that there won't be big moves. That's not what the phrase is talking about. FOMC is volatility suppressing, meaning that as we get closer and closer to FOMC, the market quits moving. It settles down, it tightens up into a range, and it waits. And volatility is movement. Movement is suppressed as we get closer to FOMC. Volatility suppressing, movement suppressing. So we don't expect to break this zone and really begin running. That doesn't mean it can't happen, and we've seen it before. Statistically, we wait for FOMC in the tight range. That's what works. But not all FOMCs are the same, and we always need more data. On all of the past FOMCs where we were sideways in a range, was the Fed already working on a tightening cycle? Were they already working on a cutting cycle? Were they on a pause mode like they are right now? That has a lot of impact on what the market is expecting and how the market behaves as we get into an FOMC. So they're not all the same. Was it, a presidential election year or not? All of those things have to be factored in when we're trying to do any sort of back testing or look back on how markets have behaved at previous FOMC events. One thing for sure, though, that we know is the longer we stay sideways, the more energy we build up. We learned a lot more about the market and how it gains energy when the fractal RSI Ligier came out. This is the concept of throwing a ball in the yard with your kids. You throw the ball, you provided the energy, and as the ball travels, it loses energy. And if nobody catches it, it hits the ground. Take a ball to a tall building and drop it off the top. As it falls, it picks up energy. Same ball. Price is very much the same thing. It can make a move with energy behind it, or it can make a move and gain energy. If it's sitting sideways, it can gain energy. We picked up on that from the RSI Ligier. Before that tool, we didn't really use the word energy with the market. We talk about trend, momentum, inertia. We didn't really talk about energy. So at the very least, sitting sideways like this, we're building up energy, but there's no directional bias to that energy. We don't know which way it's going to go. So expect to hold the line and expect a bit of a megaphone pattern. The megaphone pattern will suggest that we will continue to broaden out wider and wider until finally something breaks and we take off. And that is because liquidity resides on the other side of the pivot. So if we think about the pivot that we had yesterday, liquidity was on the other side, so price went through it. And the same thing on the bottom side, liquidity resides on the other side of the pivot, so we broke through it. Well, now we've got a new pivot, and we have a new pivot to the downside. Liquidity is on the other side of it. So if we get to the top, we're going to expect to break that top and go a little bit higher to get into liquidity while also holding the line, which means we're going to sell into strength, bring it right back down again. And that'll help build that megaphone out. A little higher across the top, a little lower across the bottom. We just expand a little bit more until finally something breaks. That would very likely be tomorrow at 8:30. So unless something happens today that breaks us out of this zone and really kicks us into gear and starts to run, we're going to expect to sell into strength and buy into weakness. Hold the line and play the range, just like yesterday. $10-day, 30-minute volume profile. We have the classic D shape with the profile point of control higher than the midpoint, which isn't really too big of a deal. But all the structure is underneath us. There really isn't anything overhead at this point, which is good. That opens a pathway higher more easily than a path down. Now, a week ago, we were talking about how much restriction there was overhead, all the different levels that were up there, how much of a fight it was going to be, and a lot of work that needed to be done to see the S&P rise. Well, it did it. It got that work done, and it's managed to rise. And now all those structures are underneath us, including all of the volume and the point of control, the put wall, zero gamma, volatility trigger. Even the call wall is underneath us at this point. We did take out that VPOC yesterday. It was the first bounce when we started to fall, when we got that first QRA data. Actually, that was before that, right? We got QRA here. Either way, we took it out, and we don't have a new QRA, a new VPOC line. Because if we zoom in and look, price was crisscrossing through that zone for like the first hour, hour and a half. So we don't have a VPOC line to add today. Now, if you study any of the volume profile books, they'll tell you to carry forward the point of control and the value area high and the value area low, whether or not they've been hit, so that you have it each day. You have yesterday's volume profile. I don't do that. I've already got enough pivots. I don't need any more. But in this really tight zone here with Friday and Monday's price. If you were to carry forward Friday and Monday, bring those pivots over into today's price action, it would probably offer you a little bit of insight, because right now that all of this is a part of that topping pattern and that hurry up and wait. It might be. Seasonality is such an odd duck, and it gets worse when you bring in seasonality for, a presidential cycle or not. And if we have recently been in a bear market or not. There's so much research that talks about after a bear market, how markets behave over the next year, over the next 2 years. So that has to be taken into account. And then for seasonality also, it's back to the Fed on, are they still holding the line? Have they announced a cut yet? Are they already cutting? Are they raising? So when you go into the past and you look at seasonality, you have to ask, was this seasonality looking at a Fed rate cycle where they were hiking? Was it looking at a Fed rate cycle where they were cutting, or were they on pause? Had they yet announced or not? Seasonality, just a seasonality chart that's only looking at what happened over the last 15 Februaries, for an example, without taking account into things like QRA and FOMC, is a blind seasonality chart. It's not offering up very much information at all. We need more info. Certainly worth looking into, though. The whole sell in May, go away, blah, 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 right? That catchphrase. I think Tom Bowley on stockcharts.com touched on that last year, because it was the year after a bear market year, and might be worth looking into, especially, on YouTube. You can just go back to last year and look at Tom Bowley in May. So speaking of hold the line, it's really clear. We've got our range for the week, and so far we haven't done anything with it except exactly what we would expect, which is holding the line. We do have a 20-50 cross on the daily. If this was equities, that probably hold more weight. I keep going back to the textbooks and the complex topping pattern, looking for something that would kind of line us up here a little bit. So here's the problem with textbooks and this candle pattern that we're in right now, is we don't have an equal high or a new high, but we've got a true, honest, real pullback. I say that because if you look at, like one of those pullbacks or those pullbacks, anything of one of those, some technician would argue, well, it wasn't a deep enough pullback. It doesn't really count, that we haven't had a good pullback since maybe way back here, and that this was just one solid run with no real pullbacks at all. And here's now a true, honest, real pullback. No technical analyst would look at that and not be able to say it's a pullback. So great, we got one. We got one that we can all agree on. But now what? Until we get another low, then we don't have a confirmed move to the downside. And until we get a lower high, we don't have a lower high. It's still on the move to the upside. So until that gets abandoned and it actually does roll over and start to go lower, we don't know that this is going to be a lower high yet. We're all pretty sure it's going to be a lower high, but you can guess and be pretty sure, or you can wait for the data. So right now, we just have a really good pullback, and we're working on this leg of the move. Now, it may all turn out to be just like this, where we pull back, we get that lower high, but we end up with a higher low and we keep going up. That's great, right? It'd be, say, a pullback of that nature and we just keep on going. That's fine. But it could end up being something like that, where we pull back and we set that lower high and we come back down and we break that low with a new low. And then we set another lower high and we break that low and down we go. We just don't have the answers yet. So while everybody's clamoring for some results or some guidance on swing trades and continuations and base case argument, this is just that really good 7% pullback that I've been looking for since the start of the year. We've got it. Now we've got to come back out of that pullback and continue the move to the upside. But unless we break this low, we're not bearish, not swing worthy bearish, not big picture bearish, as long as this low is intact. But we're not necessarily bullish either because we're still underneath that high. And until we actually get through that high, we can't be too bold up. I would be much more willing to be bullish if we can set this high and pull back and set a higher low. But we don't have our higher low. We don't yet know if this is going to be a lower high, although we're all pretty sure it will be. And we're just stuck waiting on this pattern to develop. Now, the good thing is I'm on a daily chart. So all we got to do is drop down to a 2-hour chart or a 1-hour chart. We can go into a lower time frame and find that this is tradable to the upside on that lower time frame. And of course, if we had got in somewhere around 5,000 on a 30-minute chart, then we've been good through this whole move back up and we're still good. So it always just comes down to whatever time frame you want to use. But on the daily, we don't have any clarity here yet. We are back above the anchored VWAP for the year, but we are under the 50 and we're fighting with the 20. We're back above the 10, barely, but barely does count. Adam Grimes wrote a really good book, and it's called The Art and Science of Technical Analysis, and he talks about topping patterns in that book. I've got it in PDF for free, so if you are interested in it, just hit me up. I'll throw it in chat. More than welcome to read it. It's an old book, but it's still a really good book. We're back above the 10-day. We're back above the 10-week. So far, we're just holding the line. We need to get through today, and that'll line us up for tomorrow. Bitcoin down 3%. So with that kind of move, we would expect Riot, Mara, Hut, Hive, Coin, MSTR. We would expect all of those to also be down. As we can see with Riot, that's what we'll expect with the others too. So at least we have something making some moves today. Even if we can't necessarily play the indexes, we'll be able to run, say, Bitcoin short. Gold and gold miners are also down this morning. Really not a lot of proxies to this. It's just gold, but there is GOLD like Barrick. GLD. Very likely that silver is also down. Precious metals. Yeah, nice kick in the teeth there. And likely all the other ones like JNUG and Dust and all of those. So you got that. China ADRs are down as well. So this will be the BABA, Baidu, JD, PDD. Some of that Tesla news yesterday was connected to Baidu. Apparently, the self-driving cars in China from Tesla will be using Baidu data, which is interesting. And uranium is down this morning. That's a pretty good list. It at least gives us something to focus on if we're not going to get much out of the indexes. Nat gas is up, but that's not, we wouldn't want that one out of everything that we would want out of a rally. That ain't it. What we didn't see is the FANGs down or the Mag 7 down or up. We didn't see them on either side, which is fine. I'd rather have them not helping as long as they're not hurting. And we do have pot stocks up just a little bit. They're still inside day, but they're up a little bit off of the close. And crude is up a little bit. They mentioned something the other day on crude that got my attention. Because of that narrow strait where boats were being attacked or ships were being attacked, the shipping companies are having to take a wide path, right, to go around that shipping where there's been all those attacks. Not only does that increase their insurance costs because, you know, they're traveling with all these pirates and all these attacks, but the amount of fuel needed has increased significantly. That adds to the fuel demand. And that should have been a Captain Obvious smack to the head right there. But with everything else going on, I didn't even think about it. But it does add to it, right? And it's not like the only contributing factor for energy going up, but it's more demand. You know, there's always the question of demand and use. So they can get rid of usage requests and they can do demand destruction. But in this case, it's rearing up and there's really not much they can do about it. So the projections on crude, you know, going above 85 and getting closer to 100, it's not out of line if fuel keeps going up, right? Or if demand, I should say, keeps going up. Yep, insurance too. So we got nat gas, pot stocks, crude, those are up this morning. And basically everything else is flat or down. Now, when it comes to crude, no matter what else, how else you want to trade it, I tend to look at this US OIL on TradingView. If you just type in oil or crude, you get so many symbols that you can look at. And of course, you can always just look at the futures, right? The CL. But I know some of you don't trade futures. You might not have futures data. You can use the proxy like USO. It's not perfect. But if you aren't messing with any futures data, you can go that route. If you're on TradingView, you can just use US oil. Now, I'm not talking about trading this. I'm talking about using this for looking at what's going on in crude and in oil. There's way more than this. If that's your field, you're going to want to look at gasoline costs and refineries. There's way more than that. But just as a generic scope, what's going on with crude or oil, this is where I look. So we did get that intervention from US dollar Japan. It wasn't much of anything. I mean, compared to where they've intervened before, this is nothing. And they didn't really get much out of it. We're still sitting above 150, 154, 156. So I would continue to monitor US dollar Japan and look at their 10-year after they intervened. A little bit of a smackdown. We want to continue to see this fade to the downside, even if we don't necessarily see US dollar Japan fade to the downside. But let's see this back off some. Right now, the gold just getting back down to 0.85 would be a lot. So let's get there first. Then we can start worrying about this lower level and breaking structure and moving down from there. I don't think we're going to get that move down, but we'll see. This back here, that was their last intervention. So as long as we're moving away from this, away from that 1.0, then I don't think we'll see another intervention. But if we should come back up and break this high, maybe get a little closer to that 1.0, it's very likely they'll intervene again. So the US dollar Japan by itself, I don't think is a good enough tell. Watching that's not going to give you the clarity, but the Japan 10-year, that'll offer the missing piece that you're looking for. PayPal earnings so far seem to be doing good. We have a gap close at 73. 73.20. So another $1.25, basically. If we can get beyond that, then we have another gap close. 75.50. This has been like my phoenix, rising from the ashes. Was talking about PayPal at the start of the year, and I was really bullish about it because we had at the time it was looking about like this. Like we still had this new low. We had not yet got a new high. And that was one of the conditions, right? That we needed to break above 64, set a high that's higher than this high, and then eventually get up here and challenge this. And it's been a dud all year. It's been like just a tease. But we now finally have that higher high. So we took this one out. We've been building these higher lows. Now we got to take this high out. And if we zoom out, this has a lot of work to do. But I think it can do it. It's just a long-term perspective. And so far, after talking about this thing really good in December and January, we haven't really gotten anything out of it yet. But I'm still bullish on this. It's just going to be a long, long run. These move-in pot stocks this morning, they're not really strong. We're not seeing very much flow in there, more like just algo prints. So be careful if you're looking at the pot stocks. You might be better off trying to play the shorts on the China ADRs or something like that, rather than trying to play long on pot for today, right? We're talking swing trades or day trades. Maybe a little bit of crude if you could find a couple of companies in that space that are also lighting up this morning, but at least you got some flow here. Don't really have much flow in pot stocks. They're just up, more like an algo tick. Other than that, we're waiting on data, and we're expecting to hold sideways through the day today. So just a hurry up and wait. Play the range. And if we do happen to break out, say we get above yesterday's high and we get beyond the 1236, then we can target that ADR high. So if we get above, say, 5163, it's still plenty of room. It's a 20-point move beyond that green line. So plenty of room. No reason to jump the gun. Same thing with the downside move. Although really, if we break our own low from yesterday, we're going to that ADR at that point. We would just be so close to it that there's really not much of an argument at that point. So from that point of view, you might want to just use the 1236 on the bottom of the Globex itself. Now you can take it to yesterday's high, or you can just take it to our own Globex high. 5132 is a cog line, so I like that measurement right there. If we break the cog line, I'd say run it to yesterday's low. Otherwise, if we just dip down like we did this morning and we cut under our own low, we have to get through the 111. Otherwise, it's just a bear trap. Same thing for the upside here. If we break yesterday's high, we have to get through the 111. Otherwise, it's just a bull trap. And we'd flip it and run it right back down again. Hold the line, play the range until proven otherwise. Be careful, be safe, watch the